Welcome to Ask the Expert North Texas for Monday. This is Tuesday, June 14th. I'm David Rankin.
And I'm Kristen Diaz. So glad you guys are joining us. We also have Mr. Cliff Freeman, real estate expert, joining us here from the Metroplex. And, you know, Cliff, we've been talking about the housing market during the pandemic, all the ups and downs that we've been seeing, a lot of ups, a lot of people being able to sell their home at a high price. And now with the Fed's expecting to meet this week with all the inflation rates, we're curious, how is this going to affect the housing market that we've seen?
Yeah, that's a great question. And, you know, the crystal ball seems to be getting a little clearer now. It was quite foggy, but I think the Fed announced late last night they're going to be looking at a 75 basis point increase in the Fed rate. Now, that doesn't have a direct impact on mortgage rates. Mortgage rates are priced off the 10-year Treasury. But anytime the short end of the yield curve gets a hit like that, you know, the fear is that the Fed could be pushing the economy into a recession. So, you know, the thing is if you look at housing affordability over the last couple of years, we really had, I mean, since 2020, we've had a 44% increase in home prices here. That's just last 24 months here in the Dallas area. If you combine that now with a rise of, now we're almost probably getting close to 300 basis points above where rates were 2 years ago, that really has a huge impact on affordability. Every 1% increase in interest rates at this level reduces a buyer's purchasing power by about 10%. So you got the double whammy going on here. You've got a huge increase in prices. And now the rent on the money, which is the most expensive part of home ownership, has now gone up significantly so that buyers are just getting shut out of the market.
And of course, this is affecting housing sales for most of the rest of the country, but not necessarily here in the Dallas-Fort Worth area here, because this market is still super hot, isn't it?
Well, it is. And we've been blessed with a great local economy here. You know, we have recently had an average of around 5,000 folks a week moving into this area. And, you know, we've got continued job growth. But the problem that could arise here is that if our local economy gets affected and we start to have layoffs and so forth, then houses are going to be in trouble. Even though there's a lot of equity in homes, you got to remember back in 2008, out of the 7 million foreclosures, only 1 million of those were tied to subprime loans or that systemic problem we were dealing with in the mortgage market. The rest of those foreclosures occurred because people were out of work and they couldn't pay their mortgages.
Now, a recent report has revealed that Dallas-Fort Worth has one of the lowest percentages of negative equity, or what they call underwater mortgages, here in the nation. Can you talk a little bit about that and explain that to our listeners?
Yeah, I mean, the explanation is pretty easy. We've had such a run up in home prices, you know, 44% in the last 2 years. You know, everybody's got equity in their home. You know, we're not as hot a market as Austin is, but still we're probably in the top 10 in the country. And therefore, you know, people just got lucky. I mean, you could throw a dart anywhere. It didn't matter. As long as you were throwing darts, you were going to, you know, benefit from a rising wave of price increases. And therefore you automatically just got more equity in your home. So it's been a no-brainer for the last 2 years.
Of course, you know, talking about equity and things of that nature, how does that help a person that's not necessarily looking to sell their home?
Well, for somebody who's not looking to sell their home, having equity in the home, I mean, it doesn't change things. What the problem we have right now is with this rise in prices, we've also got a rise in that dreaded property tax. You know, we live in Texas, right? We have like the highest property tax rates in the country, some of the highest. And therefore, you know, you would think that having a 30-year fixed rate mortgage, you know, you'd be set. But what we're seeing is that as home prices increase, the counties are just taking people to the cleaners, you know, with these new taxes. And that's what's causing some people. And, you know, the sad thing about it is the people that are most affected by this are the ones that can least afford it. You look at people who are, you know, the elderly and live on fixed income. Unfortunately, those people are the ones who are going to get crushed by inflation and these high property taxes now. It's really sad.
Yeah, and let's talk about this also for a second. For those first-time home buyers, that went in gun ho saying, wow, this is the time to buy a house before, everything starts skyrocketing. We're talking beginning of the pandemic, right? And when the interest rates were so low. At this point, do we, going back to the foreclosures or what we've seen in history with the market being the way it is right now, interest rates on the rise soon. Is there worry that these homeowners, these first-time homeowners, won't be able to keep up with that mortgage payment?
Well, I think, again, the key here is going to be job growth or layoffs, really, if that's what we're looking at. I mean, the Fed is driving the bus right now. And if they push the economy down and we do have layoffs, fortunately, DFW is in a very good place. We've been fortunate. We've had a lot of corporate relocations here. And so, we have a really strong job market. But, at the end of the day, if we see a massive recession, which people are starting to raise the predictions of that, and I'm not chicken little. I sleep with sunglasses on at night just in case the sun comes up in the middle of the night. But the reality is, if the economy goes into a downward spiral, it could impact people's ability to make their payments on their mortgage. I think where we're going to see the largest impact potentially would be in second homes, because if people have to stop making a mortgage payment, the first one they're going to stop paying on is not the one that's the roof over their head. They're going to stop paying for that lake house or the second home.
And that's an issue as well when people are looking for maybe a second home or their first home. Is the competition for buyers is just kind of exacerbated by the fact that there are so many investors that are looking to put in rental properties. They're trying to buy second, third, fourth homes to be used as rental properties.
Yeah, well, the institutions, Wall Street, every time Wall Street gets involved in the residential business, we see an issue usually come up. And, real estate is not really liquid. It's not like I can go trade a house on the stock market and get an instant execution. And the price elasticity, what we're seeing now is demand is going down. You're seeing a lot of institutional buyers, and it's not just humans that buy anymore. You've got iBuyers. You've got hedge funds buying homes directly from home builders. They were speculating, looking for yield because rates were so low, trying to arbitrage the residential market. Well, the problem is trying to unwind those positions could exacerbate the problem of downward pressure here. So there's a lot of dynamics in this particular case that aren't the same as they were in 2008, but you've got consumer credit card rates at all-time highs. You've got companies that are already starting to make layoffs. In fact, Compass announced a 10% layoff just in our business today. Redfin's laying off. The outlook is becoming dim. But, at the end of the day, because there's so much equity, just going back to the original thought here, because there's so much equity with homeowners here in the Dallas area, it's likely that we're going to be insulated from that. Now, the one thing to keep in mind is a lot of times it takes 12 to 24 months for these things to play out. If you remember back in 2008, when the dominoes started to tumble, it wasn't until 24 months later that we really saw the bottom of the market. So my concern is that this could be a prolonged time of either slow or no price appreciation. In fact, depending on what the economy does, we could see prices retreat for the next 24 months. It just depends on how high interest rates have to go to get inflation under control.
That is Cliff Freeman with the Cliff Freeman Group. We appreciate your time. Thank you so much.
Thank you guys for having me. It's been a pleasure.